Hi, Tony. It's been a really exciting 2025, and time has really flied, and 2026 is really in sight now. Okay. If you look back, I think 2025 is dominated by three things: tariff, AI, and de-dollarizations. And how are these three factors impacting the US economy?
Hi, Shankar. Yeah, I think this is a case of like the good, the bad, the ugly. The good has been the whole AI investment theme continues to surprise us on the upside. The investments in that area that those companies have been doing and the earnings growth they've been achieving has really beat market expectations and continues to be a strong and exciting area to invest. The bad has been the US dollar. The US dollar has depreciated about 10% in the first half of 2025 in DXY terms, and really across most currencies you would see similar patterns. And it hasn't been for good reasons. It's been concerns about U.S. policy and global investors sort of shifting away from the U.S. and leading to a devaluation in the dollar. And then I would say the ugly has been tariffs. The fact is the global economy has been holding up, but there's been a lot of uncertainty. The strength of a lot of the businesses that are having good earnings growth is a key pillar of, positive expectations in the macroeconomy. Businesses that are making profits are not that likely to start doing mass layoffs. On the other hand, I think the tariffs are likely to start to kick in towards the end of 2025. I think this is going to start to hurt the consumer more as these costs are being passed on to the consumer. And that leaves us with sort of a complicated outlook for the U.S. economy. Our base case view is not necessarily recessionary, but we do see elevated recession risks that we need to be a little bit balanced in our positioning towards the end of the year.
So, Tony, despite economic uncertainties, wars, and trade tensions, US equity markets have done remarkably well. Do you expect this to continue, or will Asia start outperforming the US?
I think the U.S. markets have been really resilient to all these uncertainties. From a starting point, that was actually very strong for the U.S. And therefore, there has been enough resilience in the economy and the markets to be able to withstand a lot of sort of negative headwinds that these tariffs have brought. Going forward, we do think that there is enough resilience that our base case is that markets should be able to continue to perform. On the other hand, we have been highlighting that there's enough uncertainties and that equities in the U.S. are sort of priced for perfection, that if there is economic troubles, then the U.S. Equity markets are a little bit at risk. Hence, we keep arguing for a little bit more diversified positions and not overly weighting too heavily and aggressively into U.S. equities alone.
At the back of things, bonds have delivered good returns this year. With US interest rates expected to fall, what can investors do to maintain their yields?
Firstly, I think the strength of fixed income around the world has been a little bit underappreciated. It has continued to perform well, has been given reasonable yields, and with interest rate cut expectations, then it's performed all the better. Going forward, it's true that, the bad part about interest rate cuts is it can affect your future yields. But we would highlight that, firstly, yields are still okay. We've just come from a decade where, we had 0% interest rate policies. And in the U.S., you still have over 4% government bond yields on your 10-year. And likewise, when we look around the regions, we particularly like Asia, which has a lot of their bonds are priced in U.S. dollars, but also the local currency bonds are seeing currency strength. And therefore, we still think fixed income can perform in the coming years.
Thanks, Tony. As we head into 2026, what is the investment strategy that clients should look into? And what are the major themes that they should include into their portfolio if they haven't already done so?
So key themes that we continue to highlight are for diversification in general. So this would be diversification among asset classes. We think clients should have a component of equities, some fixed income, and some safe haven assets that include things like gold and government bonds. And then geographically, we think investors need to make sure their portfolios are not so U.S. centric. And in particular, we like Asia, where we see Asia equities and fixed income to continue to outperform, which have better valuations, better currency trends, and an upward trend in growth. And then within sectors, we continue to like the AI theme and just innovation themes in general. We also like financials, and in particular, we've been overweighting European financials. And we think there's healthcare opportunities in many regions as well.
Thanks, Tony. Really looking forward for 2026.